Um,
Okay, hello everyone. Thank you for joining in today. We appreciate you stopping by. I'm Antonio Glenn, attorney here at AMG Counsel, located in Dallas, Texas, and I have an office in College Park, Maryland, where I'm from. And today we're going to be talking to you about investing into real estate is a great idea. And we'll be discussing a little bit about how to get into a real estate investment trust if you haven't known about it. A little bit about ROBs, rollover based startup funding, so you can fund into these real estate investments, especially now with a little bit turbulent market and different things in the market. It'll give you a chance to have some control over your financial stability and investments, and a way for you to kind of, use some of that money that you have available to invest into other other investments outside of your stock portfolio or your 401k, your traditional 401k. I'm here with Mahmood Usmani. He's here from CEO of Provision Capital. They've been in business for quite a few years, and I'll actually let Mr. Mahmood, if you want to just introduce yourself really quick and share anything.
Yeah. Hey, everyone. Thanks for having me on, Antonio. I'm Mahmood Usmani with Provision Capital. We're a real estate fund sponsor. We've been around for almost 10 years, also based here in Dallas. We've got an office in Houston as well. And yeah, I'm excited to share with folks about the different ways they can invest in real estate.
Okay, awesome. Thank you so much. So let me get the presentation started. And again, since we have a few people I think will come on later, we had to reschedule, so we have the class today. So hopefully a few participants will come on and ask questions. So I think it's Jay. If you have questions, feel free to put them in the chat and we'll get to them. So I'll get started. Um, again, using ROBs in this real estate world, it's a different type of thing about ROBs. I learned about this later on after I got out of law school, and I started working with developers and home builders in the DC area, and they were trying to fund or get different funding. In 2008, when we had the downturn, they were looking for ways to fund and get capital for their businesses. So a ROBS basically stands for this rollover for business startups. And what it does is it allows you to use some of your retirement funds into a self-directed IRA without penalties if done properly, and then fund and roll those funds over into a C corporation or a sponsored retirement plan. You can find different organizations that can help set these up for you. You can come to me as an attorney who helps clients set up their C corporation and give them business advice and advice in starting this, and how to make sure that they have the document in place to make sure they stay in compliance with the IRS, because that's the big no-no. Most of the time, these funds are used for buying a business or starting a business, and that's what you'll use the funds for. And it needs to be an active business. It can't be a business that's just for passive income. So I wanted to share that, and we'll get more into that. So why would you use the ROBs, right? What's the purpose of this? If you haven't heard of it, you're thinking, oh, this sounds too good to be true. And if done incorrectly, that's probably the case, right? Because you can get yourself into a lot of tax penalties if the rollover or the conversion isn't done properly. But some of the pros are really good. Access to capital without having to take out a lot of debt. You get to use money that you've already been saving for years in order to use these funds in order to catapult you into the real estate market. Maybe you've been thinking about other ways and avenues to get into this. And real estate investment trusts are really good. And Mahmood will talk about that once we get to Provision Capital and what they have. This creates long-term income for you. You're putting money in, you're investing it. Most of the time in these real estate investment trusts, you're getting a nice percentage back above market rate. If you put your money into the bank, at best, you might get 1%. If you're putting it into the stock market right now, it could be really volatile with all the tariff talks and some of the economic uncertainty that's going on during this session of the administration, and that may not sit well with you. So having it in real estate and having that kind of exposure is good, and it helps you have some solidity that goes along with that. The run, again, in this slide, again, structure the entity to manage the real estate activity or fund operation is really the key piece of this, right? Because most of the time people think, well, how can I get my money out penalty free? How can I do that? And that's where I work with, or Provision has a company that too helps set up and makes this easier for you to roll those funds over into a self-directed IRA and be able to inject that capital into the project, into the real estate investment field. So on the next slide, it'll go through really the steps on my end are really simple and don't go into a lot. I think for most of us, you consult on your goals and what it's going to be for. We form the C corporation, which is required for a ROBS. You can't use this with a limited liability company. And I think that puts a lot of hesitation on new business owners because they think double taxation when they start thinking about a C Corp. But a C Corp too has these other benefits, fringe benefits, C Corporation, ROBS, other ways to get funds injected into the company. And along with C corporations too, you also get to keep retained earnings, right? So funding and money that you're making in the corporation doesn't always get taxed. You're able to keep some of that for research and development or reinvestment in a company or reinvestment into like a REIT, right? So now you are able to have that taken off your financials above the line. And I think a lot of people, if they get good accounting and bookkeeping advice, it helps them understand that and they're able to utilize that in that situation. So the step 3, under the 401k plan, under the new corporation, you establish that 401k. We can do that. It's definitely on this slide, it doesn't really show like there's a facilitator or a third-party administrator that we'll talk about, that Mahmood will talk about who they use. And this administrator is the one who helps do the rollover. They help do it and keep it in compliance. That way, it's not seen as a early withdrawal from your retirement and you're paying that penalty and then that other 10% cost of early withdrawal from it. It's done in a good seamless process and then moved over. Then you use some of those funds to buy the stock into the C Corp and to fund the business. Some of the funds that you'll use from your self-directed IRA will also go into Provision, right? If you want to invest in that and use that moving forward. And then we have the ongoing advice for your compliance, making sure that your documentation is in order, you're doing the IRS standards, you're doing the URSA and all of those rules. If anyone wants to know, you can always email me if you need to know the technical rules, the IRS rules that come along. You know, with this, I didn't want to get too technical in the tax stuff because then that kind of deters people or it goes over their head. I just wanted to kind of share a little bit how ROBS can be used for you to invest and then go from there and then talk a little bit about the real estate investment trust and then come back and answer questions at the end. Again, compliance, strict IRS guidelines on the use of funds. There is maintenance required for the 401k. And sometimes too in your 401k, you can still fund your business or other ventures and opportunities with the rollover, with the ROBS. But if you have other shareholders who are going to invest in the corporation, they don't need to have that same type of investment vehicle. They can bring in money. They can bring in sweat equity, whatever you all deem in your bylaws and your other corporate documents, that's what we would include. So a little bit on your corporation is the documentation. Most corporations need bylaws. You'll probably need reasonable compensation plans because you'll need to get paid a certain salary or a salary commensurate to IRS guidelines for your role. And you get to be an employee of this C corporation that you set up. One question I normally get is, why can't I just transfer money from my existing 401k plan into a self-directed? Why can't I invest it directly into like a real estate investment trust like Provision? And normally that's against guidelines, and your employer 401k, they kind of hold on to that, right? They don't want to relinquish any rights or control over those investments based on what the arrangements that they have with your employer. So they don't allow you to go to that third party. And that's where the ROBs and the self-directed IRA come in because they allow you that flexibility. You move it out of that kind of controlled one, the directed 401k and retirement into self-directed, which means you yourself are able to make the investments and move things forward for your investment purposes. So on my end, that'll be the end. I'll roll over and I'll pull up Mahmood's slides and go from there. So give me 1 second to close this out. Mahmood, I'll let you take it away.
All right. Are you able to pull it up, or should I just pull it up on
Oh,
my
yeah,
end?
let me share again. My apologies. Can everyone see?
Yeah, that's good. So yeah, thanks for that, Antonio. I'll probably divide my discussion into two sections. One, I'll keep it pretty high level on what we do, and then really focus on how to use the self-directed IRAs to invest in private off-market investments, real estate, whether that's our fund or any additional property. So from our side, we've been in the real estate space for almost 10 years now. And our model is, pretty straightforward. We focus on single family residential properties. So what we do is we buy distressed assets, we renovate them, we rent them out, and then we sell them. So pretty simple model. It's kind of a flip fund with a rental component built in there. So, geographically, of course, we're in Texas. We've been very active here in the Texas markets, Dallas, Houston. We've also done properties in Arizona, Alabama, Florida, kind of all across the Sun Belt. So at a high level, it's a model again that focuses on residential specifically, and then the goal is there to basically focus on distressed assets, turning those around, and then just holding them for not a very long term, which is somewhat different from what a lot of maybe real estate funds do, where they're holding on to these assets for the long term and kind of generating that rental income. For us, we're mostly focused on the short-term hold. The reason we like the short-term hold, it minimizes our risk. So as the market fluctuates, we're not, beholden to changes in whether they're rental pricing, market values. Our hold is only for a few months. So if prices go up or they go down, well, our risk is very minimized there. So with that, we've been able to keep our returns pretty consistent. On average, 10 to 12% is what we've been able to return over the last 10 years or so.
Oh, that's really good.
Yeah, and a lot of that has to do with that margin, whether the market's going up or coming down, we can keep our spread because that hold is so short term. So that's what it is at a very high level. Currently, the fund size is just north of 80 million. And we have about 400 investors. And, we've had people that have been there for the long term. Most of our investors stay for the long term. They're looking for a long-term play, the compounding returns there. In terms of profiles, we've got retirees, we've got young professionals, everyone in the middle, and spread across the country, and in fact, some international investors as well.
Oh, wow, nice.
And so we've got, in terms of the types of investors, some institutional, so like endowments or larger investment funds. Some funds have invested with us as well. And then, of course, individuals who invest either through their individual account. They sometimes have trusts, so they'll invest through a family trust, and then lastly through an IRA. So
Right.
I'll come to that part of the discussion, as Antonio, you were kind of mentioning about the rules around that. So I think to date, we've created about 50 or so of the self-directed retirement accounts through the fund. And effectively how it works is someone already, in our case, has to have an existing 401k or IRA that is not with their current employer, because
Correct.
of
Right.
those rules you're mentioning. Now, technically, it's possible. We've had one employer that actually allowed it, but they had a cap
Hmm.
on the amount. So usually
Okay.
when people ask me, they say, hey, can I do it or not? I say, reach out to your plan administrator and ask them, can you do a rollover into a self-directed IRA? If they allow it, you can do it.
It's
If not,
done. Yeah.
then, right? So, a lot of obviously those investors that we have, they had it from a previous employer or an IRA that was kind of sitting out there. Maybe it was an inherited IRA that they got. And so what we do is we partner with a custodian. Custodian are your companies like Fidelity, Vanguard, these types of companies. And we create a self-directed IRA. Now, the kind of sneaky thing in the industry, your bigger custodians like Fidelity and Co., they don't allow you to create self-directed IRAs.
Yeah.
That's not an option for you. Why? Well, they want you to invest in their funds, right?
Yes.
How they make money. But there's a lot of custodians out there that do allow you to do that. We partner with Inspira Financial, but there's a lot out there. Some of our investors already have existing ones. They use other ones. In terms of finding a custodian, you can look online.
Yeah.
Obviously, you can see how responsive they are, and you can look at pricing. Generally, you're going to pay 300 or so on the maintenance side a year.
Yeah.
So that's kind of how it works on the setup side. So basically, you'll create the account, and then what you do is you do a rollover if it's a 401k, or you do a transfer if it's an IRA. But basically, you
Hmm.
take the funds from the existing custodian, and then you
Yeah.
get a new custodian. And then once it's at the new custodian, well, now you can do whatever you want, right? So
Correct. Right.
not whatever. There are some rules there.
Yeah. There are rules. Yeah.
So, you're mentioning some restrictions around what you can use retirement funds for. So one example that they always give is, let's say you use your self-directed IRA to invest in a ski resort, right? Which you
Hmm.
can do because it's a company, maybe they have an
Yeah.
offering, and send it out. But you actually could never go to that ski resort because you would be from
Oh, okay.
there's a restriction there.
Hmm.
Similarly, you can buy actual property with a self-directed IRA as well, but you can't benefit from that. And they define it via different ways. So for example, you couldn't even rent it out to your parent or your siblings or, things like that. So again, IRS has those rules out there.
Self-dealing, right?
Self-dealing.
So
Yeah,
self-dealing, yeah, is definitely, I think, and that's where, as a business owner in a corporation, to making sure that you draft your documents up to explain that in. I think a
yeah,
lot of business owners too, they don't do a lot of good minutes and stuff when it comes to like preparing the corporation or setting it up for success when the IRS comes and they say, hey, why did you do this? They don't really have a roadmap or a business direction and how they got there. Mostly corporations I know, sometimes they're small, like a closed corporation, pretty much. And so having a good board of directors, even if it's three people, I think really allows you to really set up your management structure and move forward with investment, especially if you know, hey,
yeah,
look, this is what we want to do and go after.
exactly. And I
One
think
thing you
a lot of
talked about, can you give us a little bit of a definition for, you talked about distressed properties. I'm used to that term, but what does that mean to you and what does that look like?
Yeah, and I'll piggyback on one point you mentioned.
No, okay.
A lot of folks, they want to save money on the front side, so they go a little, we've all been there,
Yeah.
where we save money. Oh, I don't need to pay this person here, this person here, but it goes a long way, I think, getting the right partners on the governance side, whether that's
Hmm.
legal, whether that's tax, and ensuring things are done properly. Because I'm sure
Hmm.
you've come across things years later after they should have set
Yeah.
up, and you're like, what were you guys doing? And they're like,
Yeah.
oh, we saved a couple grand, but now you're having to pay, 10 times as
Yeah,
much.
yeah, yeah. And I think the paperwork when it comes to these type of transactions, especially the nuances of setting up the 401 properly, making sure that if you have staff or employees, that they get to participate in this too, right? And so when you know that, and it's like, okay, I can't like you can't always skirt around or, kind of get around certain guidelines and things like that. I think it's those things where you have to be a little bit strict. And IRS has some strict documentation or strict substantiation rules. Other things you can kind of have generalities about, but I definitely, understand your point. Because then when they come back, I was like, oh, I could have paid you 3,000, but now it's 100,000 tax conundrum that I have. Now you're paying 15, 20,000 on top of what you owe. And that could be a real headache.
Yeah, no, definitely. On the property side, I mean, in terms of distressed assets, there's two ways to think about distressed. One is the property is physically distressed, which means that one way to define that is a bank won't lend on it, right? So when you go out to shop for a house and you're getting a mortgage, the lender's going to come out, they're going to do an appraisal and inspection. They're going to determine if you can. Now, if the foundations, we got
Yeah.
foundation issues here in North Texas, the foundation's jacked up,
Oh, yeah, definitely.
the roof has an opening, well, the lender's not going to lend on it.
Yeah.
So that's how they define a distressed asset, a physically distressed. And now when a bank doesn't lend on it, it basically goes to the secondary market
Hmm.
where people are either using cash or other types of financing to purchase these properties. And now when
Hmm.
it's in this type of market, you can get significant discounts, right? So that's where our
Hmm.
firm operates is, we buy these distressed assets. They're not listed anywhere. We're usually sourcing them ourselves.
Okay.
Started seeing those billboards. We buy a house.
Yeah.
We see
I've
less of
seen
them
it.
now, but
Yeah.
those are effectively kind of the methods that we're using, or just general outreach to now purchase these properties on the distressed market. And then a second type of distressed asset could be, the seller is maybe they got a new job somewhere else, they got to move across the country, and they don't have
Hmm.
time to fix up their house and list it for 6 months, wait for it to sell. They're also considered a distressed seller, quote unquote. And
Okay.
now you can come in and effectively give them ease, some cash, they can get out of the property, and now you've also
Oh,
been
nice. Okay.
a discount on that as well. So
Okay.
generally, those are the two types of properties that we're buying, and then more specifically, we're kind of in this niche middle market that we've fallen into, where most of our acquisitions are large portfolios,
Okay.
so 50, 100 plus homes at a time. And
Hmm.
generally, who we're buying from is, we call them retiring landlords. So
Okay.
someone in their 60s, 70s has owned, bought a property or two every year. Now they have amassed a pretty decent sized portfolio, uh,
Hmm.
but they're usually in really rough shape.
Yeah.
So some of the things that you see, it's actually sad sometimes. You see what kind of
Right.
conditions people are living in, or they've just been vacant for who knows
Hmm.
how long. So these types of properties, at this scale, it's too much for your one-off investor to buy, right? They can't buy
Yeah.
100 homes. And then additionally, on the top, you have your large institutional private equity funds that now own tons of properties. Well, that's too much work for them because they would
Yes.
rather, now the new thing is a build to rent. So they'll build a 100-home subdivision and now just build rental homes.
Yeah.
That's
Yeah.
where we kind of come in, where we've effectively been able to really automate and techify as much as we can our construction side, where now we can buy these homes, go in and do renovations at scale, get them up to market where they need to be, and then offload them.
Oh, okay. So two questions that I have. How is provision capital different from a syndication? I guess was what some people may ask in the chat. Can you share a little bit on that?
Yeah. So syndications, generally, those will be deal by deal, right? So
Okay.
someone will send you a syndication that says, here's a hotel in Bishop Arts, here's a apartment complex in this city, this state, or a development project, right? We're going to
Okay.
develop a subdivision. It has a fixed timeline. These are projected returns and so forth.
Hmm.
I'd say syndications are probably the most common form
Yeah.
we'll kind of see out there on the real estate side. For us, we're a fund, and so effectively the assets are already here.
Okay.
And there's the key part is there's a lot of assets. And so at any given time in our fund, for example, there's anywhere from 250 to 300 properties. So
Wow.
when someone
Okay.
invests, they're getting the benefits of diversification, right?
Hmm.
Someone will invest, let's say, 100,000 in the fund. Well, they own a percentage of every single property. And
Okay.
so there's always bad apples, right? If someone buys and it turns out the plumbing was worse than they thought, well, they might be upside down on that deal. And that definitely happens to us at scale where
Yeah.
you get 99 right, the 100th one, you have a problem.
Yeah.
So,
Right.
so,
Don't understand.
that's kind of the main, I guess, benefit on the fund side. And additionally, one thing that we've actually been focusing a lot on, so in addition to taking 401ks, we're also able to accept real property contribution. Um,
Okay. Oh
it's
yeah, like a 1031 exchange. Is that what you?
it's very similar to a 1031. So
Okay.
in a 1031, you're selling your property, taking the cash, and then putting it into new property. Uh,
Hmm.
so similar to a 1031, there's a 721. Uh,
Okay.
a 721 is effectively kind of the same, where you're taking that property and you're putting it into the fund. So
Ah.
yeah, so if someone owns
Okay.
$500,000 property, maybe what we're seeing a lot now is, insurance costs are going up, rents aren't going
Yes.
much,
Yeah.
their profit is not as high as it could be. They're
Correct.
actually contributing those in the fund and now getting ownership from that way. So that's a very tax
Ah,
advantage.
nice. So it's almost a little bit like a capital contribution of their property into the fund, right? And yeah, and so yeah, so for a business owner, yeah, capital contribution to your entity can come in different forms. Normally it can be cash, it could be sweat equity. Sometimes we work out a deal where we identify how much sweat equity you're going to do. Maybe you're a promoter for the business, you're going out getting contracts and stuff before the business has really been formed. And then you kind of turn that into sweat equity that you all agree on. And then also too, here you take a physical thing. For some people, it's like, oh, I'm donating all this like, lab equipment or laptops for the whole team. That's a capital contribution. That's my contribution to the company. So in this case, that's how that would work. Oh, okay, that's really good. Yeah. So for you all, because you do have some how much management are you doing on this construction side? Do you have a construction manager? Do you have a team that just focuses on like the rebuild or renovation of the properties? How does that look for the firm?
Yeah, so we're a people heavy operation. So we have about 45 employees total across various parts of the organization. On the construction side, we have about 4 construction managers and then about 10 to 12 staff
Oh,
that are,
okay. Hmm.
these are all in-house. They're doing the recruiting, making scopes of work,
Oh,
going to the properties, making sure everything's up to OSHA standards and
oh,
whatnot.
wow. Okay. Yeah.
We had an issue where we had to get on that. So, these are all different things that the team is kind of owning and looking at, right? So, and then under them are the actual subcontractors. So,
Hmm.
no one on our team proverbially lifts a hammer, right? No one on our
Yeah.
team
Hmm.
do the work. Portion of that is the liability side, just to separate that from any incidents or anything that occurs. But our team is basically the ones that are managing everything. And on that side, when we started this business, everything was becoming this side of the real estate commercial was already developed, right? But residential,
Right.
like, oh, that's just you're flipping houses, right? But
Yeah.
fast forward to today, it's an institutional asset class. And in
Hmm.
fact, we're seeing a lot of repositioning from commercial to residential at
Oh,
your
okay.
institutional level, which is crazy to see. So this is seen as more secure now. Whereas 10 years
Yeah.
ago, you told somebody in single family, they're like, oh, okay. Right?
Yeah. It's too
So
risky.
too risky. So similarly, and too risky, and then they didn't really see how you could scale it because, for them, okay, you got an apartment building, and yeah, you're going to have all your on-site staff, everyone will be there, maintenance. Well, technology really enabled single family to work because if you think about it, apartment building, you have 300 units in one place.
Yeah.
You can afford to have, a maintenance staff and everyone.
Yeah.
But if you've got 300 homes spread across, well, there's additional costs there, right?
Right.
Out there, you're not seeing the properties on a day-to-day basis. So we've always been very tech focused on that. And even on the construction side, we built some in-house proprietary apps where now
Oh,
we
okay.
press a few buttons, put in a few inputs, and now we have a very detailed and accurate scope. So we know how much things are going to cost. And so we've been able to put all those things into place. And I think it's been interesting to see that, this industry become more mature because you're seeing a lot of the more apps and more
Hmm.
vendors making things easier. One of our team was just showing us an app where we can put cameras on the properties just to see how everyone's, are people there on the job site? Are they doing the stuff right? So they've been able to, they had a new tile installer in the bathroom,
Right.
and he didn't put the moisture barrier, so they were able to catch it in real time.
Oh yeah, definitely. Yeah. I mean, you need that because I mean, with 300 homes, like, I mean, where insurance goes up, I take it you have to insure these homes and pay the taxes for the limited portion that you have it. I can go down the road here with, for those who, if you're not from Texas, Texas property taxes can be very, very high and can be a detriment, right? And you can see someone who gets older who feels like, hey, I've been priced out of, of having these other homes because you don't get a homestead exemption for your rental properties. You might get one for your home that you live in, but these other properties you're paying high taxes on, and it could really eat up into your profits, right? If you only have three and you're like, man, I'm not charging full rent, I don't have the resources and income to renovate the place to really ask for a higher rent, or maybe it's in a different location than North Dallas, which is much more affluent than South Dallas, then maybe you're looking at a different, arrangement there financially and go from there. So, um, well, I'm gonna let you go into your slides a little bit because I know I jumped in with some questions. And again, if you have any questions, feel free to ask. But I'm gonna get we'll just start in with his slides really quick. Mm, Can you see that?
Let's see.
Can you
I
see?
see the cover. I see the cover page.
Okay. Yeah. All right.
Yeah. So, I mean, we'll probably run through these because I think I got.
Yeah.
Uh, but basically, we've been around since 2016. We've done a lot of properties, and the fund size is just north of 80 million.
hmm
I think a lot of people get impressed by numbers and things like that. For us, it's
Uh-huh.
focusing on the process, and sometimes we even forget how many investors there are, or how big the fund is, rather, because
hmm
a lot of people are tying, okay, oh, you hit this number, you hit this number. But for us, it's more about growing sustainably, and making sure that we're making a positive impact on our communities. I think what comes up a lot is, oh, gentrification, or what are you guys doing? Are you part of this problem? And so, on that piece, we put a lot of thought into that. And, a lot of the properties that we buy are vacant. So
Right. Okay.
I was at a
Yeah,
property.
because then you kind of bring in, you're helping an eyesore in the community. And now, I guess, does your marketing team then go and say, hey, we need to go to the community and say, hey, we're cleaning this up for you. Your property value is going to go up because now we're kind of helping rebuild this older home.
Yeah,
Uh,
yeah. I was in Houston last week, and we were at one of the properties we're fixing up, and the next door homeowner comes over, and he was like, "I'm so glad you guys bought this place. It's been vacant for years, and people come in and out, and now you can see it, you can hear it, right?" And
Yeah, yeah,
yes,
definitely. Especially if they don't have an HOA or somewhere where they can kind of go in and kind of take control of that property. Then it gets a little, so HOAs, they have some good and they have some negative, of course. So does that interfere with you all when you buy? I guess you're not really in the short-term rentals, so the HOA compliance rules may not apply to you, but does it bother you in any sense in that way?
yeah, it does come up from time to time. I would say, the majority of our properties are not in HOAs, but a decent amount of them are, and a lot of them do have rental restrictions. So, they don't want, for example, a 10% cap or a 20%
Mm,
cap. But once you get beyond that, you can't rent out a house there anymore. So
okay.
we do run into that, and if our plan is to rent it, we'll try to do that diligence on the front end before we close. But there's been situations where we bought the
Yeah.
property, didn't know there was an HOA. The title company said there wasn't one.
Wow.
Rented it out we signed a lease. We're like, oh, we're good. And then a year later, the HOA is sending us letters. We're like, oh, we didn't know that. Sorry. So yeah,
Wow.
those come up from time to time, but
Okay.
a lot about risk mitigation on the front side.
Yeah, definitely. All right. Well, these are some good key terms. Anything here you wanna point out? It looks really good and
Yeah.
uh
And yeah, we have a 1 year minimum hold period on the investment. Our minimum investment's relatively low. It's 5,000. So we've kept it that way to make it accessible to people, regardless of kind of where they are. And then, of course, it says there are 401k IRA accounts we can do. And we can kind of go to the next slide.
This is really good. So for those who don't know, Schedule K1, that's more like their partnership income. So if you're on and you haven't gotten a K1, a K1 basically says kind of what your earnings are from the partnership. I take it, right? Mahmood, is that how your accounting does it? And then they have their social security number, and this money goes back into their to them, I guess, individually, or goes to their trust if someone has a trust set up. So keep that in mind. And if you did now, this 10 to 12%, this is really good on that on the ROI. And even the minimum hold of 1 year to me is that's pretty decent for your investment. Most times they want some type of 3 year commitment, unless you're like doing some type of brokerage account or something. Even if you do what is a CD with the bank, they want, maybe a year or even more. So to me, those are very attractive terms for people who are just really dipping their toe into these type of investments to not to have a long commitment or a huge commitment of more than 5,000. I think that gives you enough to see how things work and go
Yeah.
and then go from there.
And that's one of the reasons we liked single family, because real estate's an illiquid asset class, right? But within real estate, single family is pretty liquid because if you buy 10% of an apartment building, well, you can't sell 10% of it.
Right. Right. Yeah.
100 homes, you can sell 10 of them, and
Hmm.
get that liquidity there.
Oh, wow. So this slide is showing us.
Yeah, so this
Uh,
is our, just historical performance, and we kind of benchmarked it there against the Vanguard REIT index, kind of during the same period.
mhm.
It's almost double in terms of what we've actually performed and paid out to investors.
Okay. Wow. Nice. Are they a kind of a competitor for you, would you say? Or they're not in this market area and you're kind of the lone fish here in the Dallas Sea?
Yeah, I don't think we would consider them a competitor necessarily. I think that's a different, depending on how you're looking at it and how sophisticated you are as an investor. Some people, they'll invest everything that they have with us. We don't advise that because
Yeah.
you should be diversified,
Yeah.
right?
Right.
But they're not. They're like, we like you guys. We're just gonna put everything here. Okay, sure. But we're not financial advisors, and it's not financial
Yeah,
advice.
right,
Any
right.
financial advisor will tell you you should have a diversified.
Diversified. Yeah.
So, whether that's, 20% in something more stable secures, 20% something more growth, the rest in equities, and then obviously depends on your age, how close you are to retirement. But, even when you're looking at investments, you can look at it two ways. Is it active or passive, right?
Hmm.
If it's a passive investment, you have to value your time. So if I'm a doctor, is it worth it for me to now go out and buy a property on my own? Yeah, I can make 20% and not the 12% you're saying, but then I could also just make more money if that's my goal to now
Yeah,
moonlight,
yeah.
work more
I
hours.
think, yeah, I think the time piece of this investment, some people won't understand that where I can just invest the money and now I get all that time back from trying to manage my own property or three properties or even an apartment building. It sounds good, but then even if you are getting 20 and you end up having to get a management company to kind of manage that. Now you're eating into that, those gross margins and those returns, and then you're back down to 12. And so
Yeah.
it's just easier to go in this category. So that
Yeah.
makes really good sense. Mhm.
Yeah, and what I tell people is if they want to go down that route, I'm like, if you enjoy it, you should do it. Right?
Yes.
If you
Yes.
like, the idea of getting a maintenance call and going there to fix things, and I'm not saying that facetiously because my dad is like that. Like my dad's
Yeah.
he's in the fund, he's an investor, but he
Uh-huh.
likes that. It keeps him busy. I'm like,
Yeah.
why don't you should do that. But most people, I don't think they're looking for that. They're just looking for investment options.
Hmm.
Something more passive, I think, works better for most people.
Yeah.
In terms of the process, I mean, this slide and the next few slides, just kind of go into detail what we talked about, but
Oh,
basically
right.
purchasing these properties, off market, sourcing these ourselves, and that allows us to get a pretty significant discount on the front side. And really what we tell people is we make money on the buy, right? Yeah, we do the value add, that increases the value as well, but it's really about buying right that allows
Right.
us to now have that cushion throughout the process. So acquisitions definitely is a core component.
Okay.
Yeah, that's a little bit more on the acquisitions, off
Mhm.
market, cash, distressed.
Okay. Yeah, we talked about that a little bit. Oh, we talked a little bit about construction. Yeah.
So, again, our team and really the system that we've built there. So we have some in-house tools that we've built, the scoping tool there. Close
Yeah.
Jobs is another kind of in-house type of company that we built that basically, it's basically sourcing talent. So we can enter any market, get our app
Oh.
running and do onboardings and get a list of qualified contractors,
Uh-huh.
even if we haven't closed on a deal. So, if we're looking at a new market, especially, we'll start running these, vetting people so that if we do close, we can hit the ground running.
Oh, nice. Definitely. Yeah. That looks really good.
And then, yeah, on the property management side, again, we have the team here. We brought in some talent from the larger institutional shops that have really,
Hmm.
allowed us to level up a lot of our
Right.
operations and systems and processes. And, I think going to the last point there on the tenant care, it goes beyond just numbers for us. A lot of it is, how we deal with people and our faith being a faith-based firm and values,
Yeah.
that's important to us. So, we
Yeah.
never want people to feel like we have authority over them just because we have more money or we're the investors or we're the property owners. So, treating
Right.
people with dignity, respect. And, the interesting part about that is it's also good business,
Yeah, it
right?
is good business. Yes.
You know,
So on the tenant side, how many do you do the tenants as a short-term thing? Do you keep some long-term tenants? How does your tenant program work?
Yeah, so we keep the tenants. There's two answers to that. Now, within the
Okay.
fund, I mentioned there's a short-term hold. So
Uh-huh.
the
Yeah.
fund is, changing ownership. It's being sold. On the property management side, we actually continue managing for the new owners. So
Hmm.
the tenant's perspective, it's still the same property management company, same people. So we're not just putting them in there and just be like, all right, well,
Yeah.
look.
That,
Yeah, so the tenant's perspective, they have no idea that it's actually changed hands multiple
of
times.
ownership. Nice.
Still the
Okay.
same face, same experience that we want to provide.
Okay. And so on your website, maybe you can show later too. So is there a side to show, hey, I want to be a tenant in your kind of field? I guess you have a portal for rentals that
Yeah,
people can,
so our management company, the property management company is called Rent Ready Homes.
oh,
So
rent ready homes. Okay.
rentreadyhomes.com, you can see the listings and, you can become a tenant.
Okay. Okay. Nice. And when we invest, do we allocate between the two? Like, hey, I want to go to the short term, to the 1 year rentals, or hey, you know what? I want to keep my money in and kind of let it be geared toward the rent to care home portion. Does that make
Yeah,
sense?
right now it's focused just on the front side. Now down the road, we are planning to have a separate offering that
Oh,
will be more on the tenant hold side. We're
okay.
just looking for like more steady cash flow, a different risk profile. So that is in the works down the road.
Yeah, another perspectives, huh? Okay, we'll see that coming out. Okay, so additional ways to invest, I think we talked about a little bit earlier, which is good. Um, and then okay, you want to talk a little bit about your leadership? Because I don't think I met Abdullah yet, but
Yeah,
um,
so Abdullah's CEO. He's been in the real estate space informally for a very long time. His
mhm.
uncle owned several hundred units in New York
Wow,
back in the 80s. So
wow,
his kids didn't want to go see them, so he would take Abdullah. And there's one thing, I've been in the industry for 10 plus years now, and I would consider myself somewhat of an expert. You kind of know.
hmm.
But there's a different level of expertise someone has when they've been doing something their whole life. right?
Yes. Yeah.
It's learned versus it's almost just like second nature. Uh,
Yeah.
but, a lot of that expertise he brought in, and professionally, his background was in accounting, finance, worked at KPMG, Goldman Sachs,
Mm.
and worked on, he got exposed to a lot of the different structures out there that exist. And so when he came into this side, we met, and we decided to start this company together. And so a lot of the structuring and planning and, how should the operating agreements be? How should it work
Yeah.
at a high level? We still have the
Uh-huh.
layers crafting, but, at least in terms of the structuring side, that's really a lot of the expertise. And then on the day-to-day side, he's the head of acquisitions.
Okay.
And all the other kind of departments kind of roll up under me on a day-to-day basis.
Okay. Oh, well, good, good, good. Let me see. So the best way to get in touch with you, is they can send you an email, I take it, and
Yeah,
reach
email is
out.
the best way.
Okay.
And I'm always a very responsive via email. That's the best way to get a hold of me. And then happy to have set up a call with anyone. And if anyone's local here in the Dallas area, our office is in Legacy West. We can set up a meeting here in person as well.
Okay, that'll be good. Let me see what's on this class. Oh, okay. Of course, investment disclosure for everyone. Uh, this is just for education purposes. I'm an attorney, but I'm not your attorney. We're here
Yeah.
to give education. As you heard Mr. Mahmood discuss earlier, he's not a financial advisor. He doesn't invite everyone to put 100% into into the fund right away and go from there. So, is my screen still showing or it stopped?
It's still showing.
Oh, okay. Let me stop the screen share really quick. That was really good. And so I think a few questions that folks will have, I know in the replay we send it out, it'll be really good to kind of to get people to think about, okay, 5,000 investment, you know, for a year, that doesn't seem like a long commitment. I think a few things that we didn't touch on that I would share with a client is more, read the prospectus, right? Prospectus is what, or I'm sorry, a PPM, that's what you'll send. So a private placement memorandum is what Mahmood will send to you as an investor. It gives you an opportunity to kind of read up on when you see that 10 to 12%. You can also read up on the risk management on that, what's involved in their decision-making process, the teams that they use. And Mahmood, if you want to share anything on the PPM you think would be important for a potential investor, that would be great.
Yeah, the PPM is basically, here are all the reasons you shouldn't invest, right? So
Right.
yeah, you want to make sure one, obviously you want to understand what the business does.
Yeah.
Um, and two, you really want to go through the risks section. So we've taken a lot of effort to really outline all of that. And our approach to that is, okay, the different market scenarios that could exist, the different operator risks that could exist. And if you're looking at a PPM, my advice would be, whether that's ours or any PPM, is there's always risks with any investment, right? That's what
Hmm.
investment. But really you want to see, how many of these have they thought out, right?
Right.
And really asking those questions in those different scenarios. Okay, what about this? What about that? What are investor protections here? So I think that is a very core component. And then, of course, generally just understanding what the investment does.
Yeah.
And so, every investor should be well versed, and they should know where their money's going.
Hmm.
Understand, what liquidity looks like, what it looks like if they need their money out, what if it looks like,
Yeah.
you know, all these different scenarios that could come about. That's definitely the document that you want to spend some time with.
Yeah. Now, has your document or I guess the returns changed based on the economic changes that are going on with tariffs and things like that? Getting lumber from Canada, maybe other products from overseas or China. Has that impacted and will that change your model a little bit?
Yeah, I think a lot of the actual impacts remain to be seen. There's a lot of saying one thing and doing another.
Right. Yeah.
So I think everyone in the industry is they're just waiting to see what happens.
Yeah.
And
Hmm.
where obviously not just sitting around. We've had calls with high level suppliers that we use, and to get their sense on things. And so, effectively what they've told us is, they buy 6 to 12 months ahead at a time. So
Oh,
they're kind of
okay.
locking in a lot of that, right? So in terms of expecting immediate, okay, tariffs went up 50%, that doesn't mean price of goods are immediately going to go up. Now there could be bad actors, monopolists,
Yeah,
all
definitely.
that are like, okay, cool, we can raise our
Yeah.
pricing. Unfortunately, we're already seeing that in some industries. So I think that remains to be seen. I think there's still a lot of uncertainty around if we strike a deal or if we don't. On our side, we're having these calls basically every week, every other week with our suppliers, and there's some websites that we use to basically you can track some of the commodity prices, which is something
Okay.
we never thought we'd be doing.
Right.
Yes, we do this. Thankfully, a lot of our material, we don't use a lot of lumber. Since we
Oh,
do,
okay.
yeah, since we do redevelopment and not ground up,
Okay.
that actually helps us out. So most of our costs are labor costs. Material isn't as much, but it's all tied, right?
Uh-huh.
All your fixtures, faucets, appliances, well, at least the first two categories, finished products, a lot of those are coming from China. Uh,
Yeah.
and so what our reps are saying now is they don't anticipate too many price changes. I don't trust them 100%. Uh, but they said what you might see is some shortages.
Okay.
So
Yeah.
pick your poison in that
Yeah,
case.
pick your poison. Yeah, and a shortage, and I take it too because I don't know how much you buy in bulk, like how much, or do you have like a coalition of other, builders who you kind of buy with? I know in North Carolina they used to have a coalition USA or something it was called, where they just teamed up and did more collective bargaining to purchase things and get a little bit more purchase power. So hopefully your suppliers stay true. Don't put in a surcharge clause in their contracts that you don't know about, which I'm sure will start popping up on the legal side, unfortunately, where they have to address, the unknowns that come, but hopefully things will remain the same. So one of my last questions too is kind of what's the end goal for Provision Capital? Do you guys anticipate a bigger, what we call, I guess, institutional, company coming to absorb you guys? Do you think you're safe in this middle market space as you defined it? What's your thoughts on that?
Yeah, I mean, the long-term view for us is Bill and I joke. We say we want to keep doing this till we're 70.
Okay.
Something
Okay.
we enjoy doing. Like for me, I like this work. It's fun.
Uh,
It's exciting. It's something new. There's always different challenges that we're looking at. So, I mean, we see ourselves in this investment space for the long term. We're not the types that are just jumping from one shiny object to say, oh,
right.
crypto, oh, AI, like
Right. Yeah.
we have a different approach in that sense. Now, is that always going to look like a real estate fund? No, and probably not, right? As the market changes in 5, 10 years, there could be, right now we have a housing shortage of 4 to 5 million
Mhm.
homes, but if that's a 4 or 5 million surplus, well, then our model may not work, right?
Yeah.
But we're already taking some steps to kind of diversify ourselves.
Okay.
Uh, this past year, we launched a VC's part of the company,
Oh,
uh,
nice.
looking to start making venture capital investments. Right now, it's not publicly available to investors, but our goal is to do it for a couple of
Mhm.
years, establish a track record, and then it's something that we can kind of open up. Similarly, we've looked at other industries that we have some either expertise in or have a network in, like healthcare, and basically looking at different strategies. And really, it just depends on what the market gives us. So,
Yeah.
today, for example, you look at office and it's not doing well, but we see that as an opportunity, right? Like
Right.
it's undervalued. Maybe we can come in and do something different. Uh,
Hmm.
but yeah, short answer, we definitely view ourselves here for the long term.
Yeah. Well, no. Well, thank you so much for jumping on the call with me today. Sorry about the rescheduling, but we appreciate you coming on. I think everyone's really going to enjoy the replay and get a lot out of this. And I will also send a survey and get feedback too when people watch the replay. Normally they do because they get to watch it on their own time. But I want to thank Mahmood, Usmani for coming on from Provision Capital to talk to us today about rollover-based startups, ROBs, and then real estate investment trusts and his portfolio getting in. And if you need to contact him, please let me know. We'll get you his contact information and get you set up with a call so you can start, your real estate investments today. And if anyone needs me, the friendly neighborhood attorney, you know how to reach me and get in touch with me via email or text. So thank everyone for joining, and we'll be in touch soon. Thank you.
Thank you.